Hello everyone, thanks for checking out my video. The stock market fell last Friday, giving up almost all of the week's positive gains as institutions adopted a cautious approach ahead of the Federal Reserve policy meeting on Tuesday and Wednesday. As a result of last Friday's decline, all three major indices fell below their key level of 50 moving average, something that traders and investors should take note of. Also, just to highlight, the S&P 500 had its second losing week in a row. So is the bearish September taking effect already? And what should we expect for the upcoming FOMC meeting? How will it shake things up in the stock market? Let's cover them all in this video. The stock market wrapped up a wild and volatile week ahead of the FOMC meeting. The market actually had a decent rally earlier in the week, but faded on Friday. The volatility was likely a result of several mixed economic data that were reported. For instance, on Wednesday, August CPI data showed that the core CPI was slightly hotter than expected. That's bad news. But then, on Thursday, there was a report that showed US consumers are spending slightly more than what economists had expected. On the very same day, another report showed that fewer than expected workers applied for unemployment benefits. These are good news, because it shows that the economy and job market are holding up well. Meanwhile, a recent surge in oil price has worried investors that it may cause inflation to go up. That's bad news again. But a new data on Friday painted a better picture for the Federal Reserve, as the University of Michigan's Consumer Survey reported that consumers' short-term inflation expectations had moved down to a level not seen in more than 2 years. As a result of this mixed economic data, the stock market had some notable swings during the week and during intradays, and all major indices ended below their 50 moving average on Friday. That being said, they all close at a spot where they can easily reclaim this level anytime. More on this later in the technical analysis segment. Looking ahead, the key event for this week is none other than the FOMC meeting that is taking place on 19 and 20 September. The constant signs of resilience in the US economy, job market and consumer spending do make a case for more rate hikes by the Federal Reserve. But that being said, the market is expecting the central bank to hold the interest rate at current levels for this upcoming meeting. At the time of recording, the probability for a pause in September stands at 98% according to the CME Group's Fed Watch tool. Therefore, in my view, what I am looking out for this week is not so much of the Fed's decision for this month. Instead, I will want to hear what Powell has to say, like what kind of rate hike projections he and his team have right now based on the recent economic data. These projections, or rather the speech by Powell, will likely be the market moving factor rather than the rate pause decision for this month. Unless of course Powell decides to surprise the market by hiking the rate this month. But personally, I think it's quite unlikely. I mean, if that happens, I believe the market will be spooked and we could have a sell-off. Meanwhile, interestingly, the odds of a hike in November has fallen to about 27%. Previously, I recall it was above 40%. That's quite a huge drop. But of course, there is still quite some time from now till November, and more economic data will be released, so I will be watching this number along the way. Okay, let's move over to the technical analysis segment, starting things off with SPY again. Since SPY broke out of the blue dotted downtrend channel, it has been trying to break above the 50 moving average. As you can see from the chart, it has floated around this level for the last 2 to 3 weeks. This means the bulls and the bears have been battling around this moving average, and we don't have a clear winner right now. In terms of the bull thesis, we would want to see SPY put at least 2 to 3 green candles above this level, followed by filling that gap between 452 to 453. When that happens, then the broader market trend is bullish. Also, if SPY does not get rejected by the gap, there is a high chance for us to test the recent high of around 458 and even charge towards the top end of this green dotted uptrend channel. That will also mean we will likely create a new all-time high above 467. So to summarize, let's see whether SPY can fill the gap post FOMC meeting and not get rejected. If that happens, it's a very strong bullish signal. In terms of the bear thesis, two key levels to watch. First is none other than the 50 moving average again. Second, keep an eye on the 23.6 Fibonacci retracement level at around 439. If SPY continues to stay below 50 moving average this week, it's slightly bearish. And if SPY breaks below 439, it's moderately bearish. When that happens, I will be quite careful because the next target will likely be the 100 moving average at 433, followed by this final support at around 426 to 428 area. This area has to hold. Why so? The reason is simple, because when you zoom out of the chart, you will realize that's where the bottom of the longer term green dotted uptrend channel is, which started back in October 2022, about a year ago. Therefore, if SPY starts to close below it, then we can say the longer term uptrend has been temporarily broken. Interestingly, it actually happened once in March this year, where SPY plunged from a high of about 403 to 376. Don't forget, SPY represents the broader market. For it to drop 27 points in 1 week was quite massive. So, will it happen this time? I don't know, I don't have a crystal ball. If you have been following my videos, you will probably know how my technical analysis works. I basically paint both the bears and bulls thesis. And for example, if the market wants to fall, I will watch whether they can bounce from key support levels. If they can, that's bullish. I will consider going long. If they can't bounce, that's bearish. I could probably make some bearish trades. That's how we do technical analysis here. We don't predict, or at least we try not to. If the market goes up, we look at the bull thesis. If it goes down, we look at the bear thesis. Moving over to Apple. Well, fellow viewers, this was what I shared in my previous video. That ugly looking candlestick is called a gravestone doji candlestick. I think just by hearing the name, you will know it's a bearish candlestick. MACD is sitting at a spot that is ready to have a bearish cross anytime soon. So when you add all this up, Apple is looking a little bearish to me. And look at how Apple moved last week. It basically trended down since I made that bearish call. Do give me a like if that has benefited you. Anyway, come this week for bulls, we would want Apple to reclaim 178. By staying above it for 2 days or so will quite naturally give us some chance to fill that gap between 180 to 181. If it doesn't get rejected by the gap and closes above 182 resistance level, then Apple is slightly bullish. For Apple to be more bullish, it has to reclaim 185 level where the next Fibonacci level and the 50 moving average are. The final key level for Apple to overcome to have a full-blown breakout is none other than the 61.8 Fibonacci retracement level, which it apparently got rejected the last time round. Alright, here's some additional stuff to share. But before that, may I very quickly ask for your support please? Just a simple tap on the like and subscribe buttons will be very helpful for this video. It will help to push the video to more audience. I really hope to hit the small goal of 1000 subscriber mark as soon as possible. And if you would like to support the channel further, you may consider signing up for a Weeaboo account using my referral link. By doing so, you get to benefit as well. It's really simple. You just have to sign up, deposit $1 and you will get free shares. Anyway, back to business. Here's what I want to share. Market makers, or generally the market, doesn't move nicely to a particular resistance or support level and then bounces up or get rejected. It will usually exit or fall short of the level a little. I mean, as you can see, Apple went above the 61.8 Fibonacci retracement level recently for about 2 days and fell back down. This is what we call a false breakout. Market makers will trick the bulls into thinking that Apple is about to break out and then followed by a huge dump, as you can see from the big fat red candle, wiping out lots of call options in the process, and also turn some traders into backholders. And in case you think this only tricked the bulls, nah, the bears may get fooled as well. For instance, a short trader may see that Apple is about to break out and quickly exited their short positions, or they may have set stop loss above the 61.8 level and saw their put options get stopped out by market makers. So when Apple fell later, their put options were already closed and thus not able to profit even when Apple slide further down. Okay, if you have learned something at this point, do help to like the video, alright? Thanks. In terms of the downside, I am watching two levels very closely. First is the recent low of around 172. The next one is the long-term downtrend line. If it breaks below 172, we will likely feel that gap between 166 to 170. From there, keep an eye on the downtrend line. Apple has to bounce from around that area. If it does, that's bullish. If it doesn't, then I can see Apple's trend has turned bearish, even if it's just temporary. Just to add on, I am still waiting patiently to sell put option on Apple. I think it's almost reaching the level that I can make a trade already. I just need Apple to go down a little more. Anyway, what I am trying to say here is don't force a trade and be patient. If Apple doesn't fall to the level that I want for selling put options, so be it. I mean, from there, it's either I look for other trades or I reanalyze the strike price and premium that I initially wanted. This is something that I have done for Tesla if you have been following my videos long enough, where I revised my strike price from 195 to 210 and the trade still turned out well. Okay, speaking of Tesla, let's now move over to Tesla. Well, I guess everyone can see that Tesla is looking bullish right now. Since it broke out of this blue dotted downtrend channel, it has been trending upwards. In fact, it actually punched through three resistance levels, namely 246, 256 and the all-important level 266. All these three levels have now turned into support levels. Specifically, I just want to bring your attention to this 266 level because it kind of converges with the long-term downtrend line. So for Tesla to put a few green candles above this area, it's bullish. So for the upcoming 1 to 2 weeks, this area of say about 263 to 266 will be an important support level for Tesla. If Tesla comes back down to this area and bounces up, that's really bullish. Either that, Tesla may choose not to retrace back and continues its run up to fill the gap between 280 to 289, followed by 300. In fact, this is something that I have been sharing, which is above 266 and the downtrend line, Tesla has a chance to slowly grind up to 300. And that critical support area can be your stop loss area if you are trading for the short term. Not financial advice, of course. This also means if the support area breaks, then I will be very careful if I am holding on to calls as short-term trades, because breaking below this support level will almost certainly bring us to the gap below at 256 to 260. And guess what? Coincidentally, the bottom of the gap, which is 255 to 256, is where the 50 moving average and the 50% Fibonacci level are. So if this area gets breached as well, bears will be in control in the short term. Okay, let's now talk about Google. As shared in my previous video, Google seems to be in a world of its own. While many tech stocks are trending downwards, Google is still holding up or even trending upwards. As you can see, it created higher lows in the last few weeks. If you recall, I shared that the longer Google stays above this 133, 134 support levels, the higher chance that we will fill that gap between 139 to 140. Well, we are almost there, as Google hit a high of about 138.7 last week. So, will we finally see Google hitting 139 this week? Well, possible, but not guaranteed, of course. I mean, nothing is guaranteed, right? Anyway, this gap will act as an area of resistance, followed by the next level at 145. And whether Google can finally bring us to 140's range, I think it hinges on Powell's speech on Wednesday. In terms of the downside, 133 and 134 will be a decent support. If it breaks, then Google will go back down to this consolidation zone that ranges between 127 to 133. If 127 breaks, it means Google's recent bullish trend has been reversed, because that will bring Google back below 50 moving average and also into the gap area of 123 to 126. Hopping over to the option trading segment. So last week I had 3 contracts expired worthless on 15 September Friday, which means I got to reap the full premium from the trades. First, it was this cash secured put on Tesla with a strike price of 210. Tesla at one point went as low as 212 but did not breach my strike price. Ever since then, Tesla went on a monster run from 212 to the current price of 274. Next up, it was this cash secure put on Apple with a strike price of 165. Since I sold this contract, the lowest price that Apple has gone was around 172, nowhere near my strike price. In fact, the last time when Apple was below 165 was in May this year. That was one of the reasons why I chose this strike price, as Apple has been trending above this level for the last 4 months. The last contract that expired worthless was this cash secured put on Microsoft with a strike price of 300. Microsoft has been showing relative strength as compared to many other tech stocks. Quite similar to Apple, the last time when Microsoft was nearby its strike price was about 4 months ago. After I opened the trade, the lowest price that Microsoft has hit was 311, and then it rallied to the current price of 330, and therefore I got to keep the full premium. These 3 trades in total have given me $565 of profit, less trading fees of course, and since I had 3 trades that have expired recently, this means I am looking at opening new trades this and next week, so do stay subscribed to learn more about my trades. And oh, if you are new in options trading, you can check out my option trading video for beginners. I will link it at the top. Meanwhile, not gonna lie and not gonna hide anything, there is this in the money covered call option that was supposed to expire on 15 September as well. But I didn't want my shares to get caught away, so I have once again rolled out and upped for this contract before the expiration date. The previous strike price was 117.5 and now the new strike price is 120. Well, I have decided to roll it far away till December so that I don't need to manage or think about it for now. Come December, I may just let my 100 Google shares get caught away, which will then earn me $20 per share as my cost price was $100 per share. This would then mean a $2,000 profit. On top of that, I have managed to roll my option for a credit all this while, and here's the math. As you can see, if I decided not to do anything in December, the premium that I have gotten from this covered call would be $300, less trading fees which cost me about $13. So the total profit for this trade would be the earlier $2,000 and plus around $287, which gives me close to $2,300. Anyway, I can of course still roll it up and out again in December. Let's see. Alright, here are my end thoughts. The Federal Reserve has raised rates aggressively throughout the whole of 2022 and the first half of 2023 to curb inflation. Now that the inflation has fallen significantly, I would say the Fed aircraft is on its finals en route to land on the runway. But if you are familiar with the aviation industry or air traffic control, you will probably know that the finals to land is actually a critical segment apart from taking off. This is where things could potentially go wrong. Currently, I think a lot of optimism about the Fed pausing their rate hike campaign is being priced into the market. And the next step after pausing is none other than a rate cut. But because inflation remains sticky, the rate cut may not come so soon. Something that the Fed has been repeating, the so-called higher for longer approach. This is sort of like the weather over the airfield doesn't look too good or the headwind is too strong and the aircraft may be asked to go around or hold in the air longer than expected until the weather clears out. In other words, the sticky inflation eases back to the Fed's target of 2%. But don't forget, the Fed also mentioned that they are willing to continue raising rates if it is necessary to continue fighting inflation. And I believe Powell will say the same thing this week in his press conference. Therefore, if we get a pause this month, we will have to see if there are further indications of a surging inflation or hotter economy from now till the next FOMC meeting in November. It is also noteworthy to highlight that energy prices are on the rise, which could bring up inflation. And when inflation starts going up again, don't be surprised if the Fed decides to raise interest rate once more, which means the aircraft may be diverted to another FU and we could be some distance away from a safe or soft landing. Technical wise, it is obvious that the market rally of 2023 is under pressure since August with choppy and whipsaw actions, and trading during such period can be dangerous for inexperienced traders. For instance, earlier last week, the market looked to be shaking off the typical bearishness of September. But then on Friday, many stocks had a sell-off, with the Magnificent 7 all closing red. Anyway, as mentioned earlier, 50 moving average is the key level to watch for the three major indices, namely Dow Jones, Nasdaq and S&P 500. Also, as shared earlier, the indices, despite falling below the 50 moving average, they are at a level where they could rebound anytime and reclaim the moving average. This, in a way, makes it tricky for traders to trade this week, as it could swing either way post FOMC meeting. Therefore, do pay attention to the key levels that I have identified in my technical analysis segment. Some people would say there is nothing more dangerous than a choppy market, while others are of the view that one can make the most money in a volatile market, as the options premiums can be really juicy. So which side are you on? Let me know in the comment section below. With that, this is the end of the video, and as usual, please help out the channel by liking and subscribing if you have not done so. Thank you.